Guys, okay, we left it at the completion of the strategy section. And this sort of sums up the key points about strategies is that the best trades occur at the extremes near the extreme of support or resistance. We don't use really the term support and resistance. And again, it gets back to you want to look at these levels that are created from this auction as a result of this auction process as inflection points, their key reference areas. Whether or not there's support or resistance always remains to be seen when a market approaches those levels, but there are areas that can act as what is commonly referred to as support and commonly referred to as resistance. So this is a good little template for you to print out, maybe. It will be in your manual. Okay, so do you guys have any questions about the case study? Guys, are you back? Okay, good deal. Your last question. Let's see. At the point of H peak, if you bottom at 11.4, you still wouldn't move the stop. Stop movement, Daniel, is dependent on market structure, market development, but also the time frame you're trading. And if you're trading intraday and you're going to be out of that trade at the close, then there's a clock on what you expect to have happen by the close. And that may dictate you moving your stop when you wouldn't move your stop under a longer term assumption. Mel, you asked the question, would you have looked at a lower time frame for a balance area? Yeah, you can always do that, and we do that. What I showed you, this example, just using your typical vanilla 30-minute market profile chart is tradable, very tradable. As a matter of fact, sometimes I think that it might be better to cut out all the other stuff and just trade from it. But and that is a well-chosen example. But I can show you, and I will. I'll show you this afternoon when we're talking about the market coming on Monday. If you're trading structure and development, you can just trade that. These other things you can use, like on a 5-minute chart or something like that. You can identify the smaller degree balance areas, and that can be very helpful. But it's not something that's a critical component of this. The structure and the development stands on its own, which is what makes it unique. The more confidence you have, the more you will be able to trade the structure and the development of the market without these other things, even other things that have validity. I try to use less and less in my trading, not more and more. I get stuff all the time. All right, have you looked at this? What about this? Here's volume underneath a profile, and it shows volume on the bid versus volume on the ask. If you look at this, does this help? And a lot of it really doesn't. It doesn't really add anything to the equation. Okay. Tactics. Now, we said that we can all agree on the base methodology, the underlying principles and concepts that we talked about yesterday. We can agree to a degree on strategy, but there's a lot of variability in strategy. Tactics defines our involvement individually at the execution level, and there will be more variability among us in tactics and in maybe any of the other areas, such as the methodology or the strategy. Okay, we're going to talk a little bit about risk. Now, Harris gives the absolute, and he's going to talk this afternoon. I'm not sure what he's going to present because he sent me the slides and I just didn't get a chance to look at it. But those of you that have taken the EDGE seminar that Harris gives know this, and those of you that haven't taken it, that's the next thing you need to do. But risk is a very, very important, and it's a very misunderstood concept in trading. Most people think of risk as, you know, it's like a couple of you guys that are seeing this information for the first time when I say, all right, you know, I might have to use a 3-handle stop here in the ES. Well, you go, oh, whoa, 3 points in the ES. You're going to risk 3 points? Because everybody out there wants to risk 2 ticks or risk 3 ticks and expect to be able to consistently trade profitably. It can't be done. You're trading in noise. And so you have to have an understanding of risk that's more sophisticated than what your typical trader thinks of risk in terms of a dollar amount or a tick size. You can't really measure risk or determine how much risk is enough until you determine what is the potential reward. Now, the magnitude of the risk, regardless of the potential reward, always comes into play. And that is something that has to be objectively determined too. The more you're willing to risk on a given trade as a percentage of your account, the more likely you are going to run into a risk of ruining. Let me give you an example. You can have a trading system that has 70% winning trades. And if you over-leverage your account, it's not if you're going to blow up, it's when. And this happens all the time. This happens to hedge funds. So you have to have a higher, just like trading market structure and market development set you above the fray of your typical retail trader. You have to have a more sophisticated understanding of reward and risk and of expectancy than your average trader as well to be able to trade it. You know, you're not going to hear us today tell you, well, now here's a trade setup, and this trade setup in the S&P, you enter here and you set a predetermined stop in your super hyper millisecond trading platform to trail a stop, blah, blah. That's nonsense. You can't do that. Implicitly, you should understand that you can't do that by the example that I showed earlier of the variability in the volatility in the S&P from one condition to another. You can't use a 2-point stop in a market condition with an average true range of 10 handles and use the same 2-point stop in an average true range of 70 handles. But traders, for some reason, that seems to escape them. And that's why we say we trade market condition. We're not price-based traders. One size does not fit all. And this is another myth that the brokerage industry in particular and the exchanges trap you into. You know, they think, well, you know, our platform executes in nanoseconds, and not only that, but you can set trailing stops and OCOs and blah, blah, blah. Well, you can't, that's not going to be helpful to you. What is helpful to you is to understand how the market works and to have a dynamic way of evaluating reward and risk based on what the market is doing at a given point in time. The methodology itself is dynamic. It self-adjusts. You've got key reference areas and balance areas that form in all degrees of time, all the time, regardless of the average true range or the volatility of the market. And then, on top of that, if the test is, does this trade have an acceptable reward to risk equation? And then secondarily, can I afford the magnitude of the risk even if it has an acceptable reward to risk equation? So these are all questions that are far more involved than your typical trader bothers to try to to figure out. But you guys, most of you, all of our clients that have been with us a while, understand this and do that. But if you're new to us, that's a question that can be objectively resolved. And I don't know if Harris is going to talk about EdgeCalc this afternoon, but Harris has created and programmed a tool that enables you to put in the risk of a trade, the reward of a trade, the probability of a trade, and give you an expectancy, and also help you with determining how much of your account size you should trade. So that's something that is in detail, is outside the scope of the seminar we're doing this weekend, but it gives you an idea about the issues that have to be resolved. Okay, this is your simple expected return. It's the probability times the reward minus the probability of the loss, and that gives you your expected return. Now this is just the base initial expectancy, and there's more to it than this, obviously, when you're making a trade decision of how much of your account to allocate. You know, Harris takes this several levels deeper in his Edge seminar, and this afternoon he's going to talk about this to one degree or another. I'm not sure to what degree, because I haven't seen his new material. Now, this is a truth, and you know, our clients, almost without exception, tell us one of the things they consistently tell us is that they have a much more relaxed attitude about their trading, and number two is they're having bigger winners than they've ever had, and that's because of reorienting their perspective. You know, we said one of the things you have to do is have a different perspective. Well, that's what our clients are doing. They have a different perspective. So you're not going to make a living or a consistent return trading if your primary goal is to have a high percentage of winning trades. You must, however, have outsized winners to losers. Now, you may or may not have a high percentage of winning trades, but that's not the primary goal. The focus should be on having outsized winners to losers. If you will focus on that, it will keep you in the game as you figure the rest of this out. If you focus on trying to have a high percentage of winning trades, what you'll end up doing is cutting your winners short and letting your losses run, because that's how people come up with these runs of having high percentage of winning trades. The focus is on the wrong thing. Okay, this is also a truth. I do not know of a single retail model that promotes a statistically sound view of risk and return except us. Actually, there are a lot of institutions that don't promote a statistically sound view of risk and return. Okay, benefits of orientation of outsized winners to losers is much more forgiving. Much more forgiving. The same plan, the same strategies and tactics can be used in all time frames. It's a much more relaxed way to trade. This applies to any asset in any time frame. It's not going to go out of style. And it's much less susceptible to regulatory or tax policy changes than the majority of what is being promoted today as a trade methodology. Robin, all right, a couple things here. Robin says, would you agree they want to have many more winning trades than losing trades? They focus on anticipating the market, trying to predict its direction. Yes, it goes hand in hand, Robin. You know, when you reorient your focus, you get away from thinking that I'm good and right if the trade works, and I'm bad and wrong if the trade loses. You get away from that mindset, because that gets you in that predictive mode, and you worry about it from that perspective. Daniel, you say, what does this mean? Well, for instance, what if they impose a transaction tax of $2 a side on the S&P Mini? Well, that will wipe out most traders. I mean, most traders are already going to wipe themselves out. That will wipe themselves out quicker. That will wipe them out quicker. It changes the reward to risk. If you're trading 2-to-1, even 2-to-1, okay, and most S&P day traders are not trading 2-to-1. They're trading 1-to-1 or worse because they're shooting for that high percentage of winning trades. If you tack on a transaction cost of a buck a side, say, and that dramatically changes the reward to risk equation. And this is something Harris gets into in his EDGE seminar. Most traders don't factor in the transaction cost as part of the trade. They don't factor in that they're paying the bid and or the ask, as well as a commission. And that's where your true cost of trading is. This is a style that lends itself for day trading or for position trading. And I said yesterday, the shorter the time frame you trade, the more you're in the noise. Well, the shorter the time frame you trade, also, the more dependent you are on a number of variables not changing for your methodology to remain valid. And this methodology works regardless of time frame. It's not a one-trick pony. Now, I talked about this yesterday, and the prop shop influence has heavily influenced how trading is presented and how these chat rooms are run. It's guys that are coming off the floor that their edge is gone, and now they have to figure out how to make a living. And they can't, believe me when I tell you this, the floor traders have just as much trading in front of a screen as you do. That's the dirty little secret. And we have floor traders that are honest that will tell you that the floor traders, when they're off the floor, they don't have a clue any more than you do what's going on. And they're just as likely, if not more likely, to blow up than you are because they're used to trading such huge size. So get away from this high frequency, big volume, 1-to-1 or worse trading. It can't be done. Let somebody else do it. Now, this is the thing. I had a mentoring client several years ago, and he called me on the phone and he said, one of the questions that I have is, do I have any business thinking that I can do this? Because I am trading, and I'm in the same markets that Goldman Sachs is involved in, that J.P. Morgan is involved in, that Deutsche Bank is involved in, that all these hedge funds are involved in, that have millions of dollars in technology and research staffs. Can I compete with those people? And I said, no, you absolutely cannot compete with those people. You can't. But you can't lose a game you're not playing. What you can do is find the game that you can win. And that's what you're seeing today. This works for you. What we're showing you is realistic. We know it works. We trade it. It works for us, and it works for our clients. But you can't be Goldman Sachs. You can't be a floor trader sitting at home in front of a trading screen. And I talked about this yesterday, another topic I talked about yesterday, but from the top down in the trading industry, what is promoted is what is good for the industry, not for the trader. That's almost universal. And it's the regulatory agencies, the exchanges, the brokers, the magazines, the software companies, the trading advisory business itself as a whole. It's a transaction business. Your goal should be to make as much money as possible, trading as little as possible. That doesn't work for the industry. Okay. Now we're going to go back to our case study, and we're going to go through it again from a little bit different perspective. We're going to throw in here some tactics. We're going to throw in some additional information that we didn't have before. Hold on a second here, guys. Okay, now this is our rotation. Now this is volume. Now when we were doing the strategy section before, you know, we had the market that opened up and it traded higher, and you had this H period. Now, if I'm sitting there and I'm looking just at the view that we looked at in tactics, going short here would have been an iffy proposition at best because I didn't have any additional evidence. Now, Mel, you in particular, you asked the question about would you look for a balance that it was in a different context, but would you look for a balance area in a smaller time frame? I basically is what you stated. The answer to that is yes, and this is an example of it. Now, you guys, when you see Harris, when you're in the live room or when you're in the advanced trade groups, we use bar charts at least as often as we use profile charts. But we use them in a select way, and we use them through the same lens, through an auction process. Now, the only indicator that I use volume and I use breadth. That's it. I'm not sitting here hoarding some sort of magic line that I'm not sharing with you guys that just helps me mint money. I wish I had one. I don't. I've used all the magic lines. They don't work. And oscillators and all that stuff. But anyway, volume can be very helpful. Breadth can be very helpful. They're both things that are derived directly from the market itself. They are both things that can be effectively viewed through the lens of the auction market concepts that we teach to actually add an edge as opposed to detract an edge from what is already an edge. You know, Harris states this very well. I think he's in here. So Harris, if I misspeak, you can come in behind me. But you know, Harris is a mathematician, so he looks at things through that lens, which is great. But one of the things that he says, and we talk about this a lot, is there is a fallacy. Traders think that they can take something that isn't valid and then add something else to it to create validity. And you can't take two things that are not valid and have them equal validity. All you're doing is creating noise, and you can't take something that has validity and put on top of it something that doesn't and have added value to it. You actually degrade it. Yeah, Roberto, that's pretty much it. Garbage in, garbage out. Okay, so anyway, back to the example of tactics, which is at the execution stage. In this particular instance, now remember, we had a market that traded strongly. We think the bigger picture is up. But if you are an intraday trader, you are generally not going to eliminate one side of the market. You can, but you don't have to. And this is an example of, okay, now I had an extraordinarily wide range day. I had a gap up. I have extension outside the initial balance period. And if I have that, then what do the internals of the market look like? Is the market finding more buyers here or not? And the best example of whether or not there are more buyers is to see what volume is doing. And so this is about, it looks like about a 15-minute period. Each one of these bars is 5 minutes, 15 or 20 minutes. So I have a minor balance area that forms up here. And as it's forming, I have less volume. Now this is an example where I could probably, if I choose, I can probably enter a short trade with a 6-tick stop in the S&P. And if I do that, my potential is to the lower of the day or below. So I'm risking 6 tick, and if average true range is I don't know, 12 handles, that wouldn't be much. Then I've got that's a 10-to-1, 9-10-to-1 reward to risk trade. That you could be faulted for taking a trade like that. But you don't take a short trade up here and take 3 ticks out of it. Daniel, you say, what is the difference between looking at volume and an indicator such as momentum or stochastic? Well, first of all, stochastic and momentum, they're basically that's what these oscillators measure. It's a measure of momentum. It's the way they're constructed. They're basically moving averages that are bound by absolute values. They're just moving averages that are sliced and diced a little bit differently. So it's totally different. Volume is dynamic. There's no bounds on volume. Stochastic is in RSI and percent R and all this other stuff. It's a crude measure of velocity and momentum. Giampolo, you could. I mean, that gets into the finer points. You say, would you wait for an FBO type 1 to short that? You could, not necessarily. I mean, that's not a yes or no type of question. Okay, so this is the H period high on a 1-minute chart. Now, I'm going to show some 1-minute charts in this example. But the mistake you can make is going to too short a time frame. You really can't make a mistake by going up in time frame. If you'll go up in time frame, 5 minutes, we've got some people that trade. They don't look at anything less than a 30-minute chart. They don't even look at a 5-minute chart, much less a 1-minute chart. And that can improve your trading too. Okay, this is that low that formed on the 2nd that came into the upper extreme of the transition day to the upside. This is another example of volume. This happens to be tick. Now we do look at tick in the room, and tick is the net change at a point in time between the stocks traded on the vid versus stocks traded on the ask. And it will tend to diverge at extremes. Frankly, if it's going to give you almost always the same information that volume is going to give you, and so in the interest of keeping things simple, I would just use volume. Now, tick will show you this. Generally, will show you the same things. Now, we do use tick in terms of getting a general tenor of the day, sort of taking the temperature of the bullishness or the bearishness of a day. So if a day has a lot of plus 1,100, plus 1,200 ticks, what it tells us is institutions, the big boys, are buying. Conversely, if we have a day like we had on Friday, and we see a lot of negative 1,200, I think on Friday we actually had almost a negative 1,500 tick. That's telling me the institutions are selling their sell programs. So the big boys is showing conviction among the big boys and girls. The big players are active, directionally active. And so that's a better way really to use tick as opposed to like this on the execution stage. But if you're going to do it, this is the view you've got. All right, here, this is a 1-minute chart again with the volume and the tick, just showing you tactics. This is the double bottom on the day that turned out to be the transition day. And you can see on the test, volume was much, much lighter than on this low. And this is the way to view this. I'm not going to get into this in detail. There's no point in it. We talk about this in real time in the room. Now, I always, and Daniel, this really applies to this would apply to an oscillator as well. And I have had people in seminars say, "Well, gosh, Tom, these divergences are just incredible. Why don't I just trade the divergences and not worry about all this stuff and have to think and figure out what phase of development we're in and how mature it is and where the key references are? Why don't I just whip up a 1-minute chart, and when I see these divergences, use it to take my trades?" And I said, well, it won't work. And the reason it won't work is because you can never get away from the importance of context. And the context of what we do is provided from these auction market principles, and specifically development and structure. What phase of the market is trading, how mature is it, and what is my expectation under the assumption formed by answering those questions. So if I'm looking at this chart, you get a move up here, and on big volume. And then the market kind of goes sideways, and then it trades higher, and it forms a divergence here. And then it trades higher, and there's an even bigger divergence. And it trades higher, and there's an even bigger divergence. Now, and this happens. I mean, guys trade this way. And you'll see the same thing in an oscillator, Daniel. You'll get all these divergences that set up, right? And you're sitting there going, wow, this is just the world's greatest setup. I'm going to load up and sell this thing. Well, so here are my divergences. I got a little bit of a pause, and I thought this was heavy volume, but it's been redefined. And this caught me by surprise because I was so sure it was going to work, so I didn't have a stop in. So now I'm sitting up here, but now the market's starting to lose momentum, so I'm going to add to my short position. And because, volume is dropping off, and now the market goes up here, and now there's a real divergence. I know this divergence is real. Now I'm going to double up. Now all I want out of this trade, just get me out at break even. I know it'll retrace, 3 handles. I know it'll come down to 1230 and let me out. And the market goes sideways, and I'm sitting and sweating and hoping, and every time it ticks down I get nervous, and every time it ticks back up I get nervous, and then all of a sudden it makes another high. And up here I take the biggest loss I've had in 6 months and lose, 40 grand. This is what happens when you don't understand context. Now, if you understood the context of what was going on here, there's no way in the world you would have been shorting this market. This is where you were shorting the market. This was the day the market was transitioning outside of a mature balance area. When you have transition days, you will have these divergences all day long, and they will kill you. Hopefully they won't kill you. They're killing traders. But understanding this would keep you from doing really incredibly stupid things like this. This stuff is random unless it's put in a context. Now, I'm gonna go through this pretty quickly, but you apply the exact same concepts for swing trading that you do short-term trading, intraday trading. You're looking for value and the migration of value. And the migration of value tells you the trend of the market, and it helps you to determine the phase of the market and where the highest probability trades lie. I'm going to go through this pretty quickly here. All right, this was the high. This was October 2007, and this is the month. Okay, each one of these rotations is a daily bar, and you can see we formed this high volume node up here, and we began to trade lower. And look, you began the transition from the high volume node, which happens over and over again, not just in the stock market, but in all markets. And this is the composite from November December 2007. Then you started another transition lower, et cetera, et cetera. I mean, guys, this can really dramatically. Hopefully, it's already changed the way you view the market. But it can really open up incredible opportunities if you'll be patient and diligent about working with it. All right, this is the March 2009 low. Now, and we're going to talk about this at the end of the day today. The last thing we're going to do today is to analyze the markets for tomorrow, and in particular the stock market, because that's one market that almost everybody follows and is familiar with. But this was the 2009 low, and off of that low you had a persistent migration of value higher. Now this red area was a make or break time for the market, and this occurred in July of 2009, and it was the first time up to that point in time when a previous high volume node had been taken out and closed below. And what happened is this ended up holding, and you had almost an immediate bungee jump higher, and the trend resumed itself. And so in the present, and this is perfect, this dovetails perfectly into the present position of the U.S. stock market, because it's very similar to this right now. You have this consistent, persistent migration of value higher. And now it looks like we're going to test some of these lower, or at least we've already tested it in the Russell, but in the S&P, the Dow, and the Nasdaq, we're going to test these lower high volume nodes. So what happens next week is going to be really important, and it should be a great week to identify some great reward to risk trades in the stock market, but also in other markets as well. Okay, I'm not going to spend a lot of time on this because we've already spent time on it. Most of this is in your manual. I want to have plenty of time for some other things. I'm not going to go through this exercise. This is an exercise that I go through. Hopefully you guys, well, let's just do it. Let's just do it. Would you short this? Would anybody short this? No? Why wouldn't you short it? Raj, not enough info. That's true. But also, depending on the time frame you're trading, the day is almost complete. So, you've got a limited amount of time for this trade to work. You don't take a trade unless you think you've got a substantial enough reward in the trade to justify taking it. All right, now would you short the trade? No. What is this? You've got to train yourself. when you're looking at a market, don't just look at this. Look at everything else. And what is forming here? It's a balance area. And look, this is an incredibly pronounced high volume node right here, right? If we were to collapse this, and here it is. All right. This is really what you're trading. You're not just trading this day structure. You're trading the bigger development. So if I were to short this trade here, my stop would have to be below the high volume node, right? Now, with the market trading here, I know it's either going to test and or exceed this, or test and or exceed the low, right? Now, we're near the high volume node. Robin, this speaks to an earlier discussion we had about trades and high volume nodes. So in a vacuum, the only edge I have here is the fact that this market appears, based on this information, to be leaning towards the test of the upper extreme as opposed to the lower extreme. So the only edge at the moment, based on this information, would be to take a long trade with a stop below the high volume node. And then this is what happens. You have what appears to be an initiative break to the upside. But unless you understand the concepts that we've talked about and you identify this as one auction, as one structure, and if you're just looking at if you're just looking at this area, this one day, like most intraday S&P mini traders, you completely miss the ability to effectively evaluate what's going on or what might be going on. Now, if you look at this, and you have to look closely, what's another reason to have been leaning long here? And here's the hint. You can see it over here. What's another reason to have been leaning long? It's above the high volume node. Besides that, Robin. All right, here's the answer. What's this? It's the low of the day. And we've extended outside the upper extreme. So at this point, it's just a gross statistical factoid. We've extended outside the initial balance period to the upside, so there's a 70% chance the low of the day is in place. So that gives a little more statistical credence to the idea of leaning long. You know, a lot of these things like that, you know, you have to really understand them to A, to recognize them, and to B, see when they're giving some sort of a probabilistic edge to the immediate trading question. Okay, this is sort of a you guys wouldn't short this. I mean, that's obvious. Now this is a day. This is a month profile. Each letter is a day. So we're in a vertical trend to the upside. Now this is once upon a time when I used this, and I told you guys yesterday, I don't use this very much anymore because it has stopped working. And when something stops working, I stop paying attention to it. And like I said yesterday, always default to structure and development. Now, these are the moving averages of advancing issues, and this is the location of those moving averages at this point in time. Now, this is a 120-minute breadth chart, and what you have here is a divergence between price and breadth. Now, it's sort of a trick question, because what happened is this is one of those instances where you got the huge payoff because you were at a top of several degrees that could only be confirmed in the wonderful light of hindsight. But there's no way that you would enter a trade on a 120-minute chart based on this. If you were going to short this market, you would have to have information similar to the first example that we began with this afternoon, where you had a 5-minute chart, a balance area that forms, and you've got some confirmation in that time frame, so you're risking a tiny amount relative to the potential return. You know, a trade like this may have a probability of 20% or 15%. But if it's a 30-to-1 reward to risk, you'll take it. Or I'll take it. If it sets up, if it's a legitimate setup. Okay. Do you go long here? Does anybody want to take a long trade here? Why not, Robin? Robin says no. Why? This all right, this is something you guys should be able to answer. All right, what has not happened up until the M period? Okay, look, 95% of the time the market trades outside the initial balance period, right? Outside the first 60 minutes of trading. And so through the L period, which is getting rather late in the day, this market has not done that. Now think back to the example that we talked about this morning. I said the longer the day forms, the more rotations occur without taking out, the higher the low. The less the probabilities or the expectancy is with taking that responsive trade. And this is a perfect example of that alone. Now, add to that the fact that this is the next to last rotation of the day, and if anything here, you'd go short. But you would not go long. You wouldn't. There's no excuse to go long here. This is one of those relatively rare, cut and dry, no, you don't do that. Okay. All right. You go long or short here? Gianpaolo, you go short? Elena, you don't do anything? Robin, you go long? I don't do anything. There's no edge here, long or short. Based on the information you have here, no way I'd take a trade here. Now, this is a good one. Okay, here's the background. The market has just broken to the downside out of a 5-day balance area. Opened here, you have this wide range down. Do you go long or short here? Or anything? You know, you didn't take a trade. You're sitting here looking at the market. This is the background. What do you do here? Trevor, you're going short. You've learned that the hard way. Okay, Roberto, I like your answer. Nothing. The bias is short, but this is bad location. Robin, you've got a variation on the same answer. Wait for a retracement if possible, take a short. That's the better part of valor. If I come in and I've missed this move, I don't know if I want to short here because you could get a really deep retracement that you'd have to swallow. So I would wait, but I wouldn't go long. Now, just in the interest of answering the question, the only reason to go long would be if it's 10:30 and you put a real tight stop here and you're expecting some rotation. But the probabilities are against you there because of this information. The market has just broken to the downside out of a 5-day balance area. So this could just be the beginning of a multi-day or a multi-week move to the downside. Now, in the intraday time frame, you could get some deep rotation, but the better part of valor here, the higher probability thing to do is to wait for try to wait for a retracement and to put short positions on. Okay, guys, that wraps up this section of this. Now we're going to take a break, and then Harris is going to come in and spend some time with you. We'll take questions. Harris and I together will take questions, and then we're going to analyze the market and get ready to see what might be going on tomorrow and see if we can make some money. So let's take 5 or 6 minutes, and then we'll pick it back up.
Okay, recording started again. Okay, before I get into the main thing that I'm going to talk about, I just wanted to point out a couple of things, and Tom, you can certainly join in if you want to. First off, there are a lot of information that you guys have learned in the last 2 days, and one of the things I want to point out to you is that there are practical applications of almost every single thing that Tom has told you. Now, you may not realize what the practical applications are yet, but you will. But I just want to go into something that I heard this morning, and I want to explain what the practical applications of it are so that it's very clear to you the way you should be looking at things. Now, Tom described to you this morning, and I guess he described to you yesterday also, the idea of the 3-step process. You know, that you get a vertical move, you get a stopping price, and then you get a balance forming somewhere around the stopping price. So can you guys tell me the two practical things that you get out of knowing that? What are the two practical things you get out of knowing that? Anybody want to take a shot at that? Now, there may be more than two practical things, but there are certainly two very practical trading things that you get out of knowing about the three-step process. Can anybody give me one practical thing that you can use in your trading because you know that? Well, you can determine a balance, but how does that help you in your trading? Okay, well, a vertical move will stop somewhere. Okay, that's number one. That's not one of the ones I was thinking, but that's certainly something that you know that all vertical moves will eventually stop. Okay, what else? What about balances? If a balance forms, what do you know about a balance because of the three-step process? What do you know with 100% certainty? No? Well, you know there's value there, but what has to follow the balance? What has to happen? It has to move away, exactly. So that's a very practical thing to know if you think about it, that you know that as a balance becomes more and more mature, there is going to be a vertical move. It's not going to stay in the balance forever. Okay? Now, what about when you're in vertical development and it stops? And I'm going to give you a chart because I want to show you something, because I want to show you how practical this is and how important it is. Now, let me go find my crude chart from Friday, and I'm going to sort of do this. I want to close your eyes for a second because I want to hide something from you. Okay, I'm just going to sort of... Okay, this is what... I'm just going to show you this crude chart for a second. This is what was going on Friday in crude, okay? You can open your eyes again. Okay, we have crude going up, 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 up. Okay, and I had been mentioning in the room that there was a very important level for crude, that if it could manage to get through somewhere between 89.40 and 89.75, that would negate the downtrend that had started. Okay, and that was a potential place to short it. Okay, so crude is coming straight up. Okay, you can see this is as vertical as you're going to see, and it sort of hits 89.71 and it reverses. Okay, now is there a reason to worry about shorting crude here? Should you be worried that you missed the trade? Was there a reason to put a resting order at 89.71? Okay, Robin says no. Anybody else? Was there a reason to have a resting order at 89.70 so that you wouldn't miss the trade? Okay, why not? Because what do you expect to happen if this is a real stopping point? Right, if it's a real stopping point, you expect there to be some rotation, you expect there to be some balance building, and you expect the extreme to be tested. Now, it might not be tested to the tick, it might be exceeded a little bit, but you expect it to be tested. Okay, and knowing that prevents you from trying to catch this thing as it's zooming off, even though your gut is telling you that, damn, I missed the trade. Okay, and I don't know what's going to happen tonight. You know, we could gap up, we could gap down with what's going on in Egypt, who knows. But look what happens. Okay, it goes straight down. Damn, I missed the trade, right? Well, maybe not. Okay, you're starting to get the balance forming. And sometime, if this is a top, it will be retested. If it's not a top, then it's going to be taken out. So there's no reason to put a standing order here and try to catch a freight train. And there's no reason to worry about missing the trade, even though you'll occasionally. Sometimes you do get V tops, especially in crude, but it's not that often. You really do get balances forming around stopping points. Okay, so that's a good example of why what? Well, you've got, if you look at crude, you've got, and Tom and I'll go through it later. Basically, this area here is very important. If we can get through this area, then I think that it's likely that we're going to come up and test 93. If we can't get through this area, then it's likely we go back down and test 85. So, it's something I can't make a decision on right now. I want to see what happens if we get a test to here. We'll look at it when it opens. Okay, so that's an example of practical trading information that comes out of understanding theory. Okay, one other thing that I wanted to mention, and I want you guys to think about for a second, and it's sort of the way that markets move and understanding why it is that only big money can move price. Let's say that let's go back again to a chart. Let's take a look at I don't care what it is. Let's take a look at the ES. Okay. Let's say that the ES is here at 12.99. What has to happen for the ES to move from 12.99.50 down to 12.88? Specifically, what has to happen? Anybody want to tell me? Well, volume has to come in, but what does the volume do? Think about it for a second. If you're sitting there and you're a buyer of the ES, and you have your order in to buy at 12.94.50 because you're looking to buy the HVN or 12.92, what has to happen for the price to go from 12.99 to 12.88? Now take it down a little. So what has to happen? Am I going to get filled? Am I going to get filled on my order? If I'm trying to buy at 12.94 or 12.92, am I going to get filled in order for the price to go to 12.88? Yeah, right. I've got to get filled, right? What if I'm buying 1,000 cars? Do I have to get filled? Yep. What about the guy that wants to buy at 12.96? Does he got to get filled too? You guys starting to get the hang? Is there anybody that wanted to buy anywhere from 12.88.50 up to 12.99 that doesn't have to get filled for the price to go down to 12.88? Can anybody not get filled? Okay, guys, so you understand now. Obviously, it takes you or I aren't going to be able to take out every buyer on the way down. There's only one party that that has enough muscle to fill everybody, and that's big money. And that's why only big money can move the market, because everybody on the way has to get filled. Okay, and I don't know how many of you have ever thought about it that way, but that's what actually happens. Okay, so let's go. Let me get back to my little presentation here, and we'll see. And anybody has any questions as I go through this, we're going to be happy to ask. What I wanted to talk about today is aggressive trading, and when you should be aggressive in your trading, and what are the pitfalls that will guide that that your emotions will cause, that cause you to be aggressive or not aggressive, in the wrong way. Okay, so let's get started here, and let's see how we go. Okay, well, first of all, there are two ways to decide whether to become aggressive in trading. One is using math and logic, and other is using your emotions. And we know how most people do it, but we want to first examine some of the pitfalls of using your emotions to decide whether to become aggressive or not, and how to decide what to do. And then we're going to go through a bunch of examples of how to actually decide using math, logic, and auction market theory to decide when to become aggressive. Okay, so the first thing we want to notice is that humans are ill-suited for trading. The reason humans are ill-suited for trading is that humans act irrationally in the face of probabilistic situations. And there are many, many examples of that. It all has to do with probably the thing that causes it most. It's the whole reason that there's a science of behavioral economics. But at least from what we know so far, the reason for this is aversion to loss. People really don't like losing things, and I guess the scientific studies that have been done and the psychological studies have shown that the average person considers a gain of $20 and a loss of $10 to be about equal. So, the average person will weight loss about twice as much as they weight gain, and that causes us to do certain things that are not rational in terms of mathematical probability and the way that you would do things if you were really acting rationally. And I've got let me see if I can share a whiteboard here. Let me get back to my, I'm sorry, I'm going to mess up your things there. I want to show you a picture. Let me do one of my pictures here. Let's see, share whiteboard. I've got a whiteboard here. Okay, and let me see if I can draw some lines. Okay, there was an experiment done, and let me see if I can actually, shapes are actually better. Let me erase that instead of lines. Let's do a box there, and we'll do another box here. There we go. Actually, I can do lines for that. That's okay. Okay, let me do a blob, and we'll make the blob yellow. Okay, let's say that we have a rat, and we put the rat over here. Let me get my pencil. Okay, here's the rat over here, and and there's no line over here. This is I don't have an easy way to erase this line because the way I did this, but you guys can visualize that there's not really a line over here. This is sort of like just a T-maze. Okay, and let's say I put the cheese over there, and I put it over here 60% of the time. Okay? Well, what's going to happen is that the rat, I got to do a tail on my rat. Okay, we'll do a little tail on the rat. That's too big a tail. Let's give the rat we'll give him a purple tail. We'll do a pencil here. Okay, there. I've got my tail on the rat. Okay, so what the rat is going to do is the rat's going to go down the maze. He's going to sniff the cheese, and he's going to go here. But the cheese is only here 60% of the time. But what the rat will do is, whether the cheese is here or here, because it's over here 40% of the time, okay, that's 40%, that's 60%. The rat will always go to this side, whether the cheese is here or not. So it'll figure out that somehow intuitively that more often than not, the cheese is on this side, and it will always go to this side. Okay, every single time. Now, what happens if I switch the I switch these numbers here? I switch this to the 40. Let me put my thing here. Make this one the 40, and I make this one the 60. Well, what actually happens is, what the rat does is it goes over here, and it sees that the cheese isn't there as often, And after 2 or 3 tries, it adapts, and then it goes over here every single time. Okay, it doesn't think that it doesn't try to figure out the pattern. It doesn't try to figure out the pattern of things being switched. It doesn't do that. It just goes to the side that's most likely every single time once it figures out that things have changed. Okay, now, how do people react in these type of situations? And I'll give you a good psychological experiment that was done, for real, that had to do with investing. Okay, and they put a group of people in a room, and what they do is they give them a choice. There's a round, and they give them a choice, and they say that you could either have $1 and put it in the bond market and keep your $1. Okay, so you can have $1, goes into the bond market, and you keep your $1. Or you can have $2 if you put it in the stock market, but I'm going to flip a coin, and there's only a 50, and there's a, I'm going to make it $3. You can have $3, but I'm going to flip a coin, and you're only going to get the $3 50% of the time. So 50% of the time you're going to get $3, and 50% of the time you can get nothing. So does anybody want to tell me what the best strategy for that game is? We're going to do it 20 times. Okay, so you have a choice. You could either get $1 and keep the $1 100% of the time, or you can get $3 50% of the time. Okay, Raj says take the $3. Now, obviously, that is the thing. You should go for the $3 every single time, because 50% of $3 is $1.50, and you're going to average $1.50, which is better than $1. But what do people actually do? Well, what it turns out what people actually do is a lot of people the very first time will go for the $3. But what happens if they lose? What do you think happens the second time? Right, they don't. As Elena says, they go for the bond market because they lost, because they have aversion to loss. Okay? And what it turns out is that the average person only goes for the stock market, even though that's the better investment, 60% of the time. So 60% of the time they go for the stock market, the other 40% of the time they go for the bond market, because every time they lose or they get a string of losses, they go back to the bond market. Now, it's interesting. They tried that same experiment with people that had psychological problems and couldn't feel emotions. So their emotions were broken. And it turns out that the people with broken emotions went for the stock market 80%, I think 89% of the time. And whereas the average person, after a loss, was very unlikely to go for the stock market, the people without emotions were much more likely to go for the stock market after a loss. So it shows that our emotions, and that's pretty conclusive proof that our emotions are what gets in the way of us making rational decisions. Now, the other place you can see it, and let me go back to my presentation. Let's see, we'll go back to share screen. The other place, let me see it. This should have been started, but we'll start the presentation again. The other place that you can see it is in certain game shows. How many of you ever watch Wheel of Fortune on television? Anybody ever watch Wheel of Fortune? Let me get my panels back here. No answers. Nobody's ever watched that, huh? A couple of times. Okay, well, they have this thing on Wheel of Fortune now, which is very interesting. That they have this spot on the wheel that if somebody hits it, they get a choice. If they decide to take the risk, they get either $10,000 or they go bankrupt. Okay, so $10,000 are bankrupt. And it's very interesting to watch the way people react. Now, can anybody tell me what the expectation of that is? If you have a 50% chance of getting $10,000 and a 50% chance of getting nothing, what is your expectation? Anybody want to tell me? Right, but how much? What's the expectation? How much money? How much money should you expect to get on average? $5,000, right? The GM Bio has it, right? Because half the time the expectation is going to be $5,000 from that decision. Okay, but you have got to risk something because you can lose what you have. So how should that decision be made? If you have $1,000, should you take the risk or not? If you have $2,000, should you take the risk? If you have $5,000, should you take the risk? No, probably not, because you know if you have 5,000, that's like sort of on the borderline. What if you have 6,000? Should you take it? No. Okay, so we know what you're supposed to do. Okay, but what do you think people really do? Anybody have a guess what people really do? No, it's not that they don't take the risk. It has everything to do with how they're doing in the game. So they decide whether they're going to take this risk or not by whether how much money they've won so far in the game. If they've won $10,000 in a prior game, they'll take it every time. If they're winning, they take it. If they're losing, they don't. Okay, so it's a way that it's another example of how your emotions fool you. Okay, what about Deal or No Deal? Anybody ever watch that? I mean, I think that's a very popular game all over the world. Sort of gets boring to watch sometimes, but okay, you guys watch Deal or No Deal. Okay, now there was a specific instance, but this has happened many times on Deal or No Deal before. But the idea of Deal or No Deal is that you have all these, you take a briefcase, and there's 26 briefcases, and there's different amounts of money in each briefcase. You don't know how much you have, and you start opening briefcases, and then they offer you something. And once again, in Deal or No Deal, it's very easy to figure out what the expectation is, because all you have to do is add up what's left and divide it by the number of briefcases. So they had a situation on the Dutch version of the show, where somebody had, I think he had 3 or 4 briefcases left, and his expectation was about $175,000. The actual mathematical expectation, and they offered him $100,000 to stop. Okay, so he had, actually it was euros. So they offered him 100,000 euros to stop, but he didn't take it. He decided he wanted to go on because he thought he could win 500,000 euros. But his expectation was about 175,000 euros. And then he had the bad luck of knocking out the briefcase that had the most money in it. And what was left now was basically two briefcases, one that had 10 euros in it and one that had 10,000 euros in it. And they offered him 6,500 euros. Well, if you have 2 briefcases left, one with 10 euros and one with 10,000 euros, which one would you take? What's the expectation? Anybody want to tell me? Not 6,500, not 65,000. It's between 0 and 10,000. So 6,500 euros. You take the 6,500, right, Elena? Because that's on the right side of expectation. It's a better than fair offer. But what happened was that the contestant doesn't take the 6,500. You know why he doesn't take the 6,500? Well, it's a very interesting phenomenon, and it's something that has a very interesting effect when it happens to traders. The reason that he doesn't take the 6,500 is because he compares the 6,500 to the 100,000 that he could have had, and when he compares the 6,500 to the 100,000 that was within his grasp 5 minutes before, it appears to him to be a big loss. And then he looks at the 10,000 and he says, well, if I can get to 10,000, that feels good to me. I'm going to be going home with something. So what he ends up doing is taking the risk of either 10 or 10,000, turning down 6,500, which was better than his expectation, and in the end he ends up with 10. Okay, but this is a situation where even though we have natural aversion to loss and natural aversion to risk, our emotions led us to take the riskier proposition in the face of a better alternative. Now, can somebody tell me how that affects trading? Let's take this back to trading for a minute. But it's very interesting that your emotions can actually lead you not only to not take risks that you should take, but it can also lead you to take risks that you shouldn't take. Okay, so there's a few things here. First of all, as Elena says, winning streaks make you take bigger risks. Losing streaks make you pull back. Now, I see this in the room all the time. You know, it's so funny. Because in running the room for the last year, I get to see what lots of other traders do and what kinds of mistakes they make and and sometimes it's not even mistakes. I just see what they do, and it's been a very interesting experience for me. I can remember a day, about 6 months ago, where we took 4 trades in the room in a day, and the first 3 were losers. And the 4th trade was a very big winner, and we ended up with a very big winning day. How many people in the room do you think took the 4th trade? Probably only the ones that live in California and came in late and missed the earlier losers. They don't do it, and it has to do with the fact that they lose their confidence. Okay, so and then the worst part of it is revenge trading. If any of you ever been the subject of revenge trading, ever done that? You know, where you get angry at the market and you want to and revenge trading is very similar to that situation that I described with the Dutch deal or no deal player. It's a very similar type of a situation. So the main thing is I want you to be aware of this. I want you to be aware of what your emotions can do to you. You have to be able to use your emotions properly in trading, and there are proper ways to use them. But one of the things, if you're aware of what I'm telling you, it's much less likely it'll happen to you. Okay, so if we know that this isn't the right reason to be aggressive or not aggressive, if anything, being aggressive when you have a string of winners can put you into a less likely position, because if you've had a lot of winners in a row, maybe maybe the winning streak's not going to last because the move's almost over, or what you were doing isn't going to keep working. Because remember, anything that works for a certain amount of time stops working. That's why auction market strategies are so powerful, because we adapt our strategy for market condition. But if you try to take 10 responsive trades in a row in the same market, the chances are that that after a few of them work, a few of them aren't going to work. It's like let me show you an example of it. Let's go look at our Japanese yen here. Now you remember, if you guys remember, about a week ago, I guess last Monday, I gave some instructions to the room that it would be a good idea, because of what I thought I saw happening, to short the yen every time it got to 122 and to buy it back at 12.50. And you can see it went from this one. It basically we started here. Okay, so basically you could have gotten it at 12.30 here, but let's say you got it at 12.50, went right back to 12.22. You could have shorted it at 12.22, went right back to 12.50, and now it went right back again to 12.22. Okay, so if you had followed those instructions in the room, I don't know how many people did it, but if you had followed those instructions, you made 150 pips here, 150 pips here, and 150 pips here. 450 pips, not a bad day. Okay, but how long do you think this is going to go on for? Because what's forming here now? What's forming between these 2 points? Right, it's a balance area forming, and what's happening? What's happening to that balance area as we keep going back and forth between these two balances? What's happening to that balance area? Right, it's maturing. Okay, well, what happens with the average trader is the average trader has just what I told our room last Monday. The average trader is just starting to realize now. Okay, so they sort of figured out that 122 is the place to sell, and 1250 is the place to buy. Okay, are they getting in early in the game or late in the game? Right, and we know that this is going to. We know that eventually this range is going to break, and every single time now that it goes back to either one of these two extremes, the probabilities increase that it's going to break. So if you're a person that the average person that sees this happening, you say, aha, I found a good thing, but you're finding the good thing when the good thing's about to change. Okay, and it's a very interesting thing, and it affects traders all the time. What they end up doing is they end up getting into vertical conviction very late in the game, and they end up basically finding the ranges and balances very late in the game. Okay, so it all has to do with finding opportunity at the right time rather than the wrong time, and being able to anticipate it. And one of the things that you're going to find, and it only makes sense, is that when you take opportunity before it's obvious to everyone, the opportunities work. If they work, sometimes they don't, sometimes they do. But if you wait until it's obvious to everyone, the chances of things working anymore or working very well, sort of go away. So there are edges involved in trying to recognize things before other people do. Okay, so let me go back to this presentation here, and I think that's what I sort of put here. Okay, so and then it also comes down to the idea of taking the comfortable trade. How many of you like to take comfortable trades? That you sort of see in a trade opportunity, and you take it if it feels comfortable, and if it's not comfortable, you don't take it. Is that something that most of you do? Do you evaluate trades for how comfortable they are? Easy to get into, you have time to make a decision? Because I know some of you have been around for long enough that you hear me talk about all this stuff all the time. But what it turns out is that there's an extra edge in taking uncomfortable trades. And it's very interesting, because it's not that the uncomfortable trades have a better chance of working. You don't really know whether a trade's going to work or not when you take it. Because once you're in a trade, the only thing that you can hope for is big money comes in behind you on your side. And you certainly don't have any control of that. But so it's not that uncomfortable trades are more likely to work. But what do you think? What do you think about uncomfortable trades? If a trade's uncomfortable to you, what do you think other people think? You think it's comfortable to them or uncomfortable? Well, the evidence seems to be that when you get into uncomfortable trades, you're in it with less people. So you're on the opposite side of the bulk of traders. And when you get on the opposite side of bulk of traders, when your trades do work, they tend to move faster and they tend to move better, because you're catching the other traders in the wrong direction. Okay, so that's one of the ways, and that's one of the great ways that you can use your emotions, because and I know that a lot of people have actually started doing that in the room, and I tend to do it also. Is that if I see a trade situation and the trade feels uncomfortable, I use that as confirmation that I should take it. That's like one of my confirmation things. Okay, so that's another thing that I want you to consider. So let's see what else I have here. Okay, so I want to do some examples here of how to find good trade locations and how to decide to trade them aggressively and what it means to trade them aggressively. Okay, so let's go find a good market to trade. And I think we'll start with gold, because gold is sort of interesting right now. And there were some good gold trades last week. So let me go find my gold chart. And what I'm going to do is I'm going to go back to a daily chart of gold. And one of the things I like to do is I like to start analyzing things from daily charts. Okay, so we see that gold has made this enormous run up from 700. Okay, stopped a few times, made a few balances. Along the way, there was certainly a balance made in this area over here, but now we're up, and starting in, and I can take this away. We can look at it without it, so that I'm not, so that you can see. You can see that this looks like a balance. Okay, so you see that balance there. So we sort of draw this in, and we'll draw that in right over there. Okay, and what I'm going to do is I'm going to just change it to the way I had it. Volume shading, and we're going to make it gold because it's gold. Okay, and we'll make the lines black. Okay, so here we have gold. Okay, now you see this balance, and I'm going to take us back in time here. We'll take it back because I don't want to show you what happened. And we're going to put us right there. Okay, that's sort of where we were. Okay, does anybody want to tell me what they see on the screen here? Well, actually, I'm going to take us back further earlier in the week because I want to show you actually even more. Okay, let's go back to here. Okay, first of all, what do we have here? Anybody want to tell me? Balance. Now, would you say this balance is mature or not? And why would you say that? Yep, you'd say it's mature, Gianpaolo, and I agree with you. It looks like it could be mature. Okay, it's been going on since the October 13th. Okay, so here we are. Okay, so let's start to take this forward as we're watching the daily chart. Right now, where are we trading? We're trading right in the middle of the high volume node, right? We've started down. We tried to get through the high extreme a couple of times, couldn't do it, and now we're back down in the high volume node. Okay, is there anything to do here? If you're trading the daily chart, is there anything to do here? Okay, I don't see anything to do either. Okay, so there's nothing to do. Okay, so let's go forward a day. Oh, I went too many days forward. I don't know why this is moving more than one day at a time. Maybe I have to spread it out. Okay, we'll try it like that. Okay. Oop. I don't know. I hate when Market Delta does this. Okay. So here we are. Okay, we come down there. Okay, what's happened now? And let me take this balance away also so that doesn't confuse us. What's happened now? Right there. What's happened? Anybody want to tell me? Well, we didn't break out of the balance yet, but what do? We slipped below the HVN. Right? Now, what happens when we break below the HVN? Anybody want to tell me? Well, how do the percentages change? What happens once we're below the HVN? 60% chance of testing what? Testing what? What do we expect? We expect to move lower. Now, what does it bring into play? It brings into play the low of the range, right? You guys got it, low extreme. Okay, so now we have this on a daily chart. let's take a look now. Let's go to, okay, so the minute I see this, I see opportunity, okay? Because I know that this is a big balance, and the distance from where we are now to the low extreme is a long way. And also I know this is a mature balance, and it could break, right? Could break the low extreme. Okay, so I go to my 30-minute chart. Okay, let's get back to where we were there. Here we are with our break of the balance, and that was basically the spot that I had us at right there. Was right over here. Okay, so let me sort of space us back, and let's see what happens. Yeah, okay, there. I think that was it there. Yeah. Okay, this is a half-hour chart. And I don't know, this keeps jumping around on me, but I'll get the right spot. Okay, so we formed below the balance. We're starting to lean short, and we've got a balance we have a balance right here. You guys see this balance right here? And I can make this a little bit bigger because that HVN isn't quite the right size. So let's make that up to 60. Okay. Now we start to rally back up, and we can't quite reach this HVN. Okay, we reach this HVN over here, but we can't quite reach that HVN. Now you guys know what happened afterwards, but this is actually a spot where a lot of our room members went short. Okay, they actually got short at 77.70. I think, Robin, you took that trade, didn't you? Okay, and the reason that now this is a very aggressive trade, isn't it? It's not actually it didn't actually get into this this last balance that formed, so you can't really call it a failed breakout type 1. But there's a reason to be aggressive here, and the reason to be aggressive is because we've fallen below the HVN of a daily balance that could be in the process of breaking to the downside. Does everybody understand that? Okay, so then let's take it forward a little bit further. What happens is that we move forward a little further, and we start to break down, and then we form the balance over here. And I'm sorry, for some reason there's a bug in market delta, and it's not doing the balance exactly where it should, but the high volume node is in the right place. Okay, and we go down, and we come back up, and now we come back up into here. Now this is a failed breakout type 1. Would you guys take a short trade here in this 45 to 47, making believe that you didn't see that over there? Now, I actually called this trade on Twitter last week, and the reason that I called it was exactly because I was looking at exactly what I'm explaining to you here. Okay, and look what happened. We ended up actually breaking initiatively out below. We got down as low as 1310. Okay, now if you look at what's happened in gold now, as we space forward here, is on Friday we sort of bungee jumped up. We came right back into this HVN and pulled back a little bit. But now we're in the now can anybody explain to me what the current market condition of gold is and what you're seeing in regards to that big balance? Okay, but we've rallied back into that big balance now, right? After attempting to break down. So what do we call that when you attempt to break down out of something and it rallies back into the balance? What's that called? It's an FBO. Well, we don't know if it's an FBO2 or an FBO1 yet, Giampaolo, but it is a failed breakout. Okay, so what do you expect to happen at a minimum in a failed breakout? What usually happens, and what do you expect? Right, you expect it to reach the HVN. Okay, now right now it's rallied back up into this little balance here, and it stopped. Now, do you want to automatically short it at this little balance? Okay, if it comes back up here to 45 to 50, do you want to go short here? And if you do, explain why. Okay, you said you don't. Why not, Jim Powell? Right, because it's likely to go to the HVN. Okay, so that's how you use the big picture to guide what you're doing in the little picture. So there's no reason to be aggressive right now. But what if it rallies back up to 82 and stalls? In that case, is there a reason? In that case, is there a reason to be aggressive? Right, because then it becomes a ping pong trade. Exactly. Okay, so this is a good example of how you use market structure to decide to be aggressive. And in deciding to be aggressive, remember, aggressive doesn't mean that you risk more money. The amount of money you risk should always be guided by edge calc or the equivalent of edge calc. It doesn't mean that you risk a bigger percentage of your account. What aggressive means is a few things. First of all, you take aggressive setups. Okay, so you take the setups on the 5-minute balances instead of waiting for a 30-minute balance. What it also means is that you're willing to take a few shots. You know that if you take a shot at 80 and it doesn't work, you may take another shot at 84. Okay, or there are obviously a few different ways to do it. You could also just decide to go short with a bigger stop and take less leverage if you have a big enough account. But the point is that aggressive means that you first of all don't miss the trade. You don't sort of like get lackadaisical and look at something else and miss the trade. That's number one. And number two is you aggressively try to get into a position. But aggressive does not mean that you load the boat because you never do that. You always allocate money in accordance with mathematics. Okay, Daniel, I don't know if you remember back to your How to Trade webinar, which I'm sure you must have watched. There are certain standard setups that we use, initiative type setups, and we have an FBO1 and an FBO2. Do you remember that? Okay, you have access to it if you didn't see it. But at any rate, there are two standard setups. Two of the standard setups we have are an FBO1, an FBO2, and a ping pong. Okay, and the case of a failed breakout, the failed breakout trades will all happen when you have when you have balances of any type. But in this case, it's a big balance, and there's an attempt to break out of the range of the balance, and you come back inside the balance. And basically, there's two things that are likely to happen here. One of two things. One thing is that we come back up to the HVN and we fail and we go back down. We call that a ping pong trade. And the other thing is that we rotate through the entire thing and test the 1434 and break out the other side. That would be a failed breakout type 2. And I think Tom must have showed you that earlier today or yesterday. Did Tom show you some examples of failed breakout type 2s where they rotate through everything? Tom, are you there? We lost Tom. Didn't Tom show you some examples of things that tried to break out and then they go through the entire structure in a fraction of the time?
Harris.
Yes.
I'm here. Yes. As a matter of fact, we saw some today. I mean, that's one of the uncanny setups across all markets and all time frames. When you have a market that attempts in a mature balance area that attempts to break out of one extreme, and if it fails, the trade through that range will occur in a fraction of the time it took to take it. That's the big example that I showed you guys yesterday using the Dow, and that's sort of a huge time frame, but there are numerous examples of that. As a matter of fact, I'm looking at one in the Euro right now as I'm writing the report. So it happens all the time. I mean, that's in all degrees of time. So yeah, they have seen that.
So, but basically, what I was showing them is the fact that there was a reason to be aggressive in gold to the short side, but now that it's come back into the balance, that you don't want to aggressively short it until you see what happens at the HVN of the bigger balance.
Gold had every opportunity to collapse last week, and now you're getting a bungee jump. So, the jury is out, as they say.
Right, the jury is out. Okay, so I think that's a very good example of how you can use daily time frames to find locations and when things get into good locations on the daily time frames, they really give you great opportunities to fine tune in the shorter term charts. Now, most traders, even if they knew this, wouldn't do this because you don't get great locations on daily time frames in every single market every day. Okay, it just doesn't happen. But different things happen in different ways. Now, if you look at the ES, and I'm going to go find my ES chart again here because I sort of minimized it before, I think, and I don't want it minimized. Let's see, ES. Let's see if I can bring it back. Yeah, there we go. Okay, now those of you that are in the room know that starting after we went from 96 to 67 and came back sort of into here and was making this balance, I was talking about the fact that we could be forming a bigger balance. Okay, but let's go back in time here to about a week ago, or a week and a half ago. And let's say that we're sort of right here. Okay, so this is where we are. We're sort of right there, and of course this structure isn't here yet. Okay, so you've seen us go from here to here, and we're starting to rally back. Okay, so the very first thing that I see here is that we're possibly forming a range. I don't know that this is a range. I don't know what's going to happen, but one thing I do know is that we're not likely to make a V-top at 96. Now, why do I know that? Why do I know that we're not likely to make a V-top at 96? Anybody? Because if it's a stopping point, what should happen? If it's a stopping point, what happens after a stopping point? Right, balances on balances until they until they rotate around a bit, right? Okay, so it's not balanced yet. It's maybe a range, but it's a balance. What happens? What has to happen here for this to be a balance? What makes this into a balance? From what you see on screen, what has to happen? Sometimes it does happen, right? Both extremes have to be tested, right? Okay. It's not a balance until both extremes are tested. I'm sure Tom told you that. Okay, so we don't have anything yet, but once you have this, where are the locations where you should be aggressive? Okay, this is what you've got. Where are the locations you should be aggressive? And remember, this isn't here yet. As a matter of fact, I'm going to take it away so I can always put it in later. Okay, where are the locations that you should be aggressive? Right, Raj says at the extremes, top and the bottom. Should you be taking trades in the middle? Okay, should you be taking trades at 1285 and 1280? What if a failed breakout forms 1285? Is that a good spot to be aggressive? Right, the middle right now is random. First of all, you got an elevator shaft here. You don't have any idea where it's going to stop, and you don't know. Okay, so what happens is that we go along, and you go along here, and we do eventually test the top. Okay, so now we have a test of the top, and actually what happened is we formed a balance. So I'm going to put my okay, now once we get to this top here, what do you expect to happen? What do you expect once we get to if this is going to become a balance? Now, we don't know for sure yet that this is going to become a balance, but if it is going to become a balance, what do you expect? We're in a good trade location now, right? So you want to be, is this a spot to be aggressive? Yes or no? Yes, right? And you have a choice. You could either be aggressive long or aggressive short, if you think that it's just going to continue going up. But to me, in looking at this, does this look like strong vertical development to you? What does this look like to you? Does this look very one-sided or very two-sided? Okay, so the fact that it looks very two-sided, that doesn't mean that it can't two-sided its way, up to 1320, but it looks two-sided. Okay, as Daniel says, it looks corrective. Okay, and we can see what ends up happening. All of last week is we made a balance at the top, and then sure enough, that balance resolved down, and that's sort of where we are now. And I'm going to put my my balance in now. So what do we have now? In terms of this theory that I had, that we were in the process of forming a balance. What do we have now? Let me straighten out my my stuff here in the meantime while you guys are figuring out what we have. What's been confirmed now? What do we have? First of all, has the high of the range been tested? Has the low of the range been tested? Well, I don't know. Would you call if we closed at 70? The absolute low is 67. Would you call that a test of the low? If we gap up tonight and go back up, would you consider that to be a test of the low of the range? I'd consider it to be a test of the lower range. It doesn't have to be tested to the tick. It's close enough for me. Okay, so you've now in effect, and let me get this all the way to where we are because we closed on the low tick. In effect, you've had the high of the range test. It didn't stop at 96. It went a little bit above it. It actually got up to 99. Okay, so it went a little bit above, and it's possible that we're going to stop here. It's possible we're going to go a little bit below. But if this is a balance that's forming, what do you expect to happen from here? Do you expect that we're going to go straight to 1200, or do you expect that we're going to maybe rotate back up and test the high again? What do you think? What's your bias? Yeah, that's basically what my bias is. Doesn't mean it's right, and it may go to 1255 first. It could also go to the low 1260s. But I want you to look at something from the recent past that it appears to be following the same pattern of. Okay, let's go back to our daily chart here, just so that you understand how things generally work. Okay, and we're going to go back to the Battle of 1200. Now we're at the Battle of 1300 now, which is sort of interesting. We're going to go back to the Battle of 1200. Okay, so let me see if I can do this on a 16-minute chart. Let me see if I can get back that far. This is, I'm going back to, let's see, I got to get back to 4/14 of 2010. So let's do a 60-minute chart, and let's see if I can get back to there. 4/14 of 2010. Is that it? Yeah. Yeah, that looks like it. No, I'm not sure. Let's see. Nope, that's not the right spot. 4/14 of 2010. That's 9, 8, 6, 5. And we're getting close. Okay, there we go. 4/14 of 2010. Okay, we came up, we came down, we made a minor new high, we came down, we came up, and then boom. Okay, so this was the balance that was made right here. This is the balance that was made in attempting to get above 1200. Okay, so one swing down, one swing up, one swing down, one swing up. And I think this one came back up again. I don't know, let me see. Actually it did. That's not big enough. Actually, I should get this on 120 minute. I'm not going to do it though because I'm going to lose my spot. But let me let's just watch this develop. Okay. Okay, so we made a top. We came down and established the bottom of the range at 66. We came all the way back up to 95. We came down to 71. Okay, we went back up to 1200. Okay, so we expanded the range to the upside. We came all the way down to 65. And then we came back up again to 80, 88 to 90, and then I think we fell apart. And it's interesting because we fell apart right at the top of this elevator shaft. And the fact that we couldn't get through this elevator shaft was actually the signal that, besides the fact that this was very mature, I think it had gone on for about 15 days by the time we got there. Actually, a little bit more, and then finally we actually came down. Again, if you look at this on the daily time frame again, you can see the balance that actually formed up there. This one right over here. Okay, so that appears to be what might be happening now. We don't know for sure because we don't have a crystal ball, but if that is what's happening now, we're sort of like right over here. And there's still another rotation or two to go. It's certainly, well, the whole thing, Gianpaolo, is that the very first test of the low of a range, because remember at that point you don't know it's a balance. Well, your bias right now has to be up because we're in an uptrend. My bias for Monday is to watch what happens. I want to see what happens when we open. But I think that the next thing that's more likely happening than not is that I don't know if we're going to actually test 67. I don't know if we're going to go into the low 60s, but I do think that once we do bottom here, not too far from where we are, we're going to have a rotation up. That's more likely I think that's the more likely thing to happen. Especially since we seem to be going down on the basis of political news. Now, obviously, I can't tell what's going to happen in the world. And you obviously have risks now because if the Egyptian thing spreads all over the Middle East, then that can obviously disturb things. Okay, but are you guys getting an idea of how important it is to watch the really bigger picture, like the daily charts, and to orient your trade by the locations, the important locations on the daily charts? instead of just basing everything on what you're seeing at the moment. And that's really the key to knowing when to become aggressive. And it's good because we just happen to be right now in important areas on a whole bunch of important daily charts. Anyway, Tom, I think now would probably be a good time for us to start going through some of the current markets, because we can show everybody some of these opportunities that we're seeing, and let them apply their newly found skills.
Okay, Harris, let's give them about 2 or 3 minutes here. Okay, take a quick break and then we'll wrap up. Come back and wrap up.
Okay, why don't you pause the recording, and I'll give you back the ball.
Okay. Let's talk about some markets here. We'll start with the stock market. There are a couple things to show you. We have been, the interesting thing, this is the present example of the stock market is very similar to the example that I used in the webinar or the seminar earlier webinar from 2009, and actually you can go back to 2007. This plays itself out over and over again. And as I said yesterday, you've got all these people scratching their head and writhing in angst and anxiety because the market's doing something it shouldn't be doing. Well, that's their definition of things. An objective definition of the market through the lens of what we're exposing you guys to says the market's acting perfectly normally. It is trading in a phase of vertical development. Now, based on Friday's action, now I'm gonna get rid of some of this stuff here because it's sort of redundant. So we've got a vertical trend to the upside. This is an area that we've been talking about for some time. 1300 is special just because it's 1300. No other reason than that. What is interesting now is that you're really trading down into a sort of a broad key reference area from 1270 down to 1256. And why is this area important? Hopefully, and I know that some of you can look at this and immediately understand why this level is important. Well, let me answer the question. There are two reasons. Number one, not far below the low on Friday, we've got the completion of the selling tail from the 20th. Now, based on the momentum Friday, I would expect this to be taken out. But if you notice, this is the last balance area prior to the jump up, and it held on this test, and now it's being tested again. So my best guess is, and this is a guess, is that the market is going to form at least a short-term low somewhere between Friday's low and 1255. Now 1255 is 16 handles lower, so is that tradable information? No, that's more background conditional information. Now, do I expect that this high will be the all-time grand intergalactic supercycle high? No, I don't. And the reason I don't expect it to be is because of the history of how the stock market typically forms tops. And it very seldom invert V tops like this. There are more examples than I can show you of what the market will typically do at a market top is form balance. So my working assumption, and this is what you have to do as a trader, you have to form working assumptions. And that's different than predicting, and it's different than guessing. The working assumptions are based on all the principles that we've shared with you for the past 2 days. You know, you start with, in which phase is the market trading? Is it vertical development? Is it horizontal development? If it's vertical development, then what I'm expecting on a retracement is for the prior high volume node, the area of balance, to hold. And if it breaks, then at that point in time, I can change my assumption and adjust, well, maybe, you know, this is going to be a more protracted or a wider range balance area that's forming than I thought. But unless this area breaks, my working assumption is you're going to form at least a short-term low in here. And from that point, then I want to judge what happens on the ensuing rally. Now, the other reason that I think that we may be near a short-term low here is because of something else that we showed you, is breadth. And breadth tends to take on the personality of the trend that's in effect. Breadth finally reached negative 2,000 on Friday. It had been mid-November since it had reached that level prior to this. That is quite a long period of time between negative 2,000 breadth readings, even within a strong vertical bull trend. So each time this market in this rally has reached a negative 1,000 breadth or negative 2,000 breadth, all right, this is the August low. Now, wait a minute. I'll tell you what. Let me do this so I can line this up. I'm going to go to a cash chart. Now we'll line up. You know, the extra 15 minutes in the futures and Globex, etc., throws the charts off. So, all right. So the last time the market was negative 2,000, or the beginning was, we had in August. We had a negative 2,000. You got a bounce very shortly thereafter, and then lower lows, and this was the kickoff to this trend. But since this time period here, we've really only reached negative 2,000 or right at it twice. Here, this was the day of a low, and this was the momentum low that was tested, and then we're off to the races. So if the bull trend is still in effect, at a minimum, what you should have here is weakness that holds, or additional weakness that holds following some minor balance in this general area in here. And that's my working assumption. Now, that working assumption is based on the development and the structure of the market, first and foremost, and secondarily on how breadth has behaved, and how, not just in this trend, but this is something that I've been using for most of the 26 years I've been trading. I can go back and show you similar situations in the rally off the 2009 March low, where breadth, when it would get oversold, you'd be at or near a momentum low with very little price damage following substantial retracement. So you can just sort of go through here and you can see. And you guys have seen this in the report. I've done this numerous times in the past. So, etc. And so my working assumption is that once again, we're probably near at least a short-term low in price. We'll have some retracement, and even if we make a lower low, this area is going to hold. Now, that's really good information. Now, I'm not suggesting that you go long on, in Globex in the futures at 1270 and close your eyes and put a stop at 1250. You could do that, but you don't have to do that. It gets back to the example that we used before, where we're going through the rotations and what would happen. You, as an intraday trader, you can use this information on a more macro basis as a backdrop for your decision making as to what happens when Globex begins trading, or if you don't trade Globex, what happens when the market begins trading on Monday morning. And those of you that are in the live room, Harris will be walking you through that. But this is the working assumption. This is what you will hear me say. Those of you that listen to the report tonight, I'm sort of giving you a preview of what I'll be saying tonight. Now, there are a lot of markets, as Harris points out, that are setting up really nicely. Part of the all-in, all-out stuff. All these markets seem to be offering opportunity at the same time. Bonds and notes are two of the markets. Bonds are in about as mature a balance area as you're ever going to see in any market. You're going to get an initiative situation out of here. I guess we're going to find out pretty early on Monday if this is the beginning of the initiative break to the upside, or if you're just testing the extreme again. But increasingly, the edge is with identifying and getting on board the initiative trade in bonds and notes. Other markets of interest, I think that of particular interest, the Canadian dollar. The Canadian dollar, this is a very important area in here. The Canadian dollar has traded below this high volume node now, and this is an area that has contained buying tails for the past, well, this year. If this area breaks, it would portend potentially very sharp trading lower somewhere, potentially 98. That's a guess. Now, if the Canadian dollar bottoms in here, because this is a mature profile, this appears to be an attempt to break below it, then you could have a very sharp move all the way through this area and test this 101.53, 101.22 area. Let's see. The Australian dollar is also coiled up. It's in a mature balance area. Take gold. Now, Harris talked about gold. And gold looked for all the world like he was going to zero on Wednesday or Thursday, and now we V-bottomed in this area just below the low extreme. And we've been talking about this area, and we'd identified this area in the reports as being important. Now, gold is traded back up into an area that's an upper key reference area. You've got selling tails in here, and this is where the market really began to break down prior to this low. And then above here, this is an area that includes the high volume node of this much larger structure. Silver's in a similar position as gold. So, you know, the list goes on, and this is what you want to do. You want to scan your charts at night, listen to the report that I send out, and find the markets that that have a market condition that are in approaching or in trade location from where you have the best reward to risk opportunities, and then come in during the day, and you can drill down further on shorter term charts, 120-minute charts, 30-minute charts, even 5-minute charts, to help you find trade location and refine your trade location, and you can get some incredible reward to risk trades that way. So that's pretty much all I have, guys. Now, do you guys have questions? Trevor, okay, let's take a look. Fair question. Let me find my intraday charts. Okay, Trevor says, hey Tom, from Friday's high we are in vertical development down, and the balance we built Friday should hold if we continue lower first. Am I crazy thinking of the overnight lean for my own short? Okay. Well, Trevor, and this is the chart that is going to go into the report. Now, you had a remarkable elevator shaft here. This 1279 quarter is the top of the elevator shaft. This area was tested. you could easily, now this is an area you want to keep an eye on, but quite frankly, I would not be shocked to have trading above here deeper into this area. My best guess on a loose stop, if you want to try and really hold this trade, is probably got to be somewhere around, excuse me, 88 to 90. And that's the area that from where the market really broke down. Now, I think what will happen is that even if this is exceeded, what you'll do, you'll come up here like this. I don't think you'll go straight to this area and through it. I think you're more likely, if you do get through here and you do have some relatively sharp rally above this level, that wouldn't be too surprising, that you'll be able to fine-tune a stop. Mel, you ask a good question. And Skip, yes, I'll look at VIX in a minute, okay? Mel asked the question, at the end of your last presentation, you mentioned that you would wait for a retracement before you would enter short. How would you determine that you reached enough of a retracement? That's a great question. And Mel, it's not so much about the retracement as it is what happens when you think you have formed, what you're looking now. If this market does this, if it goes from here to here, then what it's done in this time frame, it's basically formed a phase of vertical development of minor degree. And at that point, what you're looking for is the stopping price and the development of a range. And then what you're doing is you're basing your trade decisions on this. Now, I would be biased because of all this vertical conviction down, but you don't know. You don't assume anything. You're trading market structure and development. Now, the market it may not come up to here, Mel. It may not come that high. It could very easily, actually, trade from here back to this area that it tested. And then if it does that, then it will make this 1279, 1280 area more important and a higher probability lean. Giampolo, so if a market is vertical up, the very next balance below is a sort of last resort. Is that a general rule? Yes. Skip, you ask about VIX. Yeah, there's, I keep an eye on VIX, but I don't, there's all this attempt to trade and to determine VIX and how far it's trading away from a moving average or Bollinger Bands and all this nonsense. I keep an, let me see if I can find, yeah, here we go. Now you had this tremendous bungee jump in VIX. I keep an eye on VIX just to see if it's relatively high or relatively low. I don't have I've never been able to determine, and nor have I ever found anyone else is able to determine valid signals from trading VIX. I'm not saying that they aren't out there. I'm saying I haven't found them and I'm not aware of them. Guys, anything else? This is an interesting question. I'm just sort of scrolling up, and Harris may have answered this. I don't know, but if he did, I'm gonna answer it also. Daniel says, back in April, May, where would the trades have been taken? Would you have been waiting weeks for trades? No, you wouldn't. Are you talking at that point in time? Were you referencing this area? Yeah, I know it was an old question. I find it an interesting question, though, Daniel. If it was answered to your satisfaction, I'll let it lie. Well, that's the neat thing about this market, this methodology, is that you can have a strong vertical trend like this, but even if you have a strong vertical trend, you can go down in time frame to identify trade opportunity. Now, something else I'll point out here while we're talking. A lot of traders have a really difficult time when a market is trending because they're afraid if it's trending up, they're afraid they're going to be the one that buys the top tick in the market. So they don't know how to get on board. And remember, and this is something we've already said, if you go and over time, if you listen to this enough, you'll hear all these things and you'll remember them. But the general rule, a general guideline is when a market is trending vertically, the best key reference areas against the trend in effect is the previous day or two's extremes. So if the market is trending up, generally you can count on the previous day's low or the day before that's low holding. And if it doesn't, then you default to the closest high volume node below that level. And if you look at this chart, that would have served you very well and does to this moment. Now because of this wide range day we had on Friday, we've taken out the lows of a bunch of days, and now we're into the next high volume node, the next area of balance. And we want to see what happens in here. Anything else, guys? It should be a great week. We're looking forward to it. I want to thank all of you for your time and your attention for these 2 days. This is certainly not the first time a lot of you have seen this. Hopefully those that are seeing it for the first time will not only review the recording, but the next time we give it, we'll come back live. And I can almost guarantee you that you will take away something new each time you watch it and each time you see it presented live. I am behind in terms of updating my charts, and that's something that will be done by the next time we give this. Mel, you say, are you asking the question, do you trade with 5-minute charts often? Yeah, fairly often. I mean, but if I'm looking at a 5-minute chart, I'm not trading the 5-minute chart. I'm just using it to fine-tune execution. I'm really trading the larger degrees of of development. Well, Daniel, that's something he can help you with in the live room. Giampolo, how many times a year do you give this seminar? 3 or 4. Daniel, you asked the question. So you don't use tick charts? No, we don't use tick charts.
Yeah, Daniel, generally the lowest time frame we go down to is a 1-minute chart. And that's only to look for certain divergences when we're trying to fine-tune trade entries. It's not for finding setups.
Well, Skip, yeah, I see your comment that this was eye-opening. Thank you. I hope so.
Yeah, T-Bone, as far as the ES goes, I think Tom pretty well drew in where the HVM below is. And where 67 sort of got barely into it, it extends all the way down, depending on how generous you want to be with its boundaries, to 50, or at least 58 or 57 or 55 or something like that. But that whole area, I think you could think of as the HVM below.
Yeah, and another reason this area is important is because it includes that initial January trading. This is the initial trading for 2011. So, your institutional types will be going apoplectic over what happens in here or doesn't. Well, Trevor, you want to hold your short back to 1175? The market doesn't care. Just trade the market, Trevor. If you're willing to hold that position all year and have it go to 1350 against you first, then that's fine. But if you're trading the immediate time frame, that's probably not the best line to draw in the sand.
Yeah, Trevor, you have to watch what happens. But if we do show signs of bottoming in the low 60s or at 67 or on a test of the low, it's not a bad place to take a long. And then the main thing you're going to see is if we start rallying back up, we start getting a frog blow or a bungee jump back up, you got to watch how it reacts to that elevator shaft coming down, and how far it gets up. Will tell you a lot. And if we can't get through that, very much of that elevator shaft coming up, you can always go back short, or you could add to your short, depending on how you play in the trade. But we're not going to basically, unless we can break 50. I wouldn't be looking to be aggressively short. If we break 50, then then you're in another ball game.
But something else, you don't have to worry about that, because along the way, you're going to have balance areas that form that give you the opportunity to enter short if that's the thing to be done. You'll have balance areas that include retracements against the downtrend, and then you can make decisions. So you don't have to sweat missing something. Roberto, that's awesome. I told you. Good stuff. That's it, Trevor. That's pretty much the formula there. No, by no stretch of the imagination is the EDGE seminar redundant to this class. Each seminar, each webinar that we do is its own material, and having watched this seminar will help you with the other seminars. Now that you've gotten this is the foundation. Everything derives from this, Daniel. But by no stretch of the imagination is the EDGE redundant to this. It will be as eye-opening to you as this was.
Yeah, Daniel, the EDGE basically, when Tom and I first started working together, this was the only seminar that existed. And there was an enormous demand for us to do a seminar on trade management. And the EDGE is my attempt to do a seminar on trade management. So it not only covers trade setups and how to manage trades, but it also gets into the whole idea of money management and trading as a business and all the different things that you have to consider. Yeah, the EDGE seminar, I'm not sure yet. Tom and I were talking about it. It might be late February, it might be early March. It's going to be in the next the next one we do, though.
Okay,
before that we'll be doing Alan's option seminar before that.
Yeah, I was just going to say, you guys should watch Tuesday night. It's free, and you get an idea about if you want that service. But this should give you an idea of the difference in the way that we do things and the quality of what we're presenting to you. We don't tell you the trading is easy. We try to give you a solid foundation. So, you know, we're doing things differently, but it's Harris and I both are excited about what we're doing, and we're excited about you guys. I mean, we've got clients that are doing really well and that are sharing what they've learned and advancing rapidly in their own trading. And Robin, you certainly are, you know, as I like to say, the poster child for that. So it's neat that some of you guys that I know are advanced traders are watching this, and you can see the value in it. So that's cool. That's cool to see. Harris, great stuff. Nice work as usual. Thank you.
Well, thank you too, Tom.
So, guys,
anyway, you'll be getting the recording sometime this evening on this as soon as WebEx gets around to giving them to us, and same way as last night, and Tom's report will be out. I don't know, what time do you think the report will be out, Tom?
I'm gonna try and do it right now. Hopefully, it'll be out within the next hour.
Okay, good.
Elena, you're welcome. Roberto. Oh yeah. You guys that are taking this for the first time, I will get the manuals to you within a week. I've got to print them out, but I'll get them to you.
Yeah, Skip, if you want to join the room, the thing to do is to sign up for the How to Trade webinar. That's $300, but it also covers your first month in the room. So it's basically you're paying for your first month in the room at the same time, and that way you're brought up to date on all of the actual setups we do and a lot of the stuff. So it avoids a lot of the questions that would normally come up in the room, for really basic stuff. So just go to the front page of the website and click on what you have to do to take the How to Trade webinar, and that's like a quick 2-hour webinar, and it has a lot of practical information in it.
Alan, thank you. Hope you had a good bike ride this morning. Ooh, rain, tough one. Okay, guys, we're going to wrap it up. You guys take care. We'll see most of you tomorrow morning.